Hi, in this video, I'm going to show you how you can actually sell a calendar put spread on low IV season. And this is only possible when you're actually doing margin trading or futures trading. However, please note that selling futures and margin is actually at a high risk. So please monitor your risk before you actually try to sell a calendar put spread. Now I'm going to show you very quickly what's actually happening in the market. So I'm going to use NDX, Nasdaq as an example. And last week there was a plunge, and yesterday night there was a plunge there was a sell-off in Nasdaq as well. So let's take a look at this graph. This is Nasdaq. Okay, this is Nasdaq, and just yesterday there was a sell-off from almost 5,009 to 5,800. Almost 100 points down, and it's about 2% down. Now, so let's see how you can actually sell a calendar. Now, if we were to sell a calendar, this is the settings that I just pulled out. Later on, we will go through with that in a while. There are some points that you can try to sell. Selling a calendar is somewhat similar to selling a vertical spread. However, it is based on a difference in two different expiry dates. So a vertical, usually you will sell at a higher price and then buy back at a lower price, and that's where you get a premium. So net is a credit. So similar to selling a calendar put, you get a premium from selling. So these are the prices. Okay, very briefly, how you actually do a sell is you sell a trade that is further away, for example in October, and you buy back one that is 1 month or 2 weeks earlier on expiry date compared to the previous trade, okay, at a lower cost. Alright, so let's take a look at the price. This data is taken from Think or Swim when you actually do a scan stock on the Nasdaq. So I'm scanning only these few dates, mainly on the September 29 and October 20th. So there is approximately about 1 month difference. Alright, so these are the strike price. I'm going very far away. If you take a look over here, the strike price that I choose are usually very far away. It's like 10 or 20 delta. More importantly, let's take a look at the mark change, the price change overnight. So the night before, on the 16th of August, price was 5,900. Alright, and within a day it drops, and that's where our price actually increased. However, let's just take a look at what happened if we were to enter the trade when the market is actually at its highest peak and the IV is actually very low. So what I will do is let's draw analyze, and let's go to think back. I'm going to set my dates back when it was 15, 16, okay, so about 15, 16. I'm using option trade on Nasdaq because I can't pull up the futures price from the think back. So this is the best price, so we're going to use this as a closest price that you can get when you are entering a trade like this. So we're going to check on the price that expired on the 29th of September. Let's take a look at the price when it is on August 16, that is 2 days back. For the strike price of 5,200, the mark, I'm going to compare mark price only because bid ask spread is a bit too far away to compare. So I'm going to check on the mark price, 5,002, and it is buying and selling at around $10.45. So I'm going to erase all this so that you guys can follow me. I'm going to key in the price. Alright, so I'm going to set it as September, a quick setup of September, and the price when it's September, and the strike price of 5,200 would be $10.45. Alright, and at 5,300 it is price of $13.80. Alright, so this gives us the price 2 days ago before the IV spikes. So we're going to check on the expiry at 1 month later, which is on 20th of October. Alright, and we're gonna pull all the way to 5,200. Okay, so 5,200 mark price is $20.20. Alright, and 5,300 will be $25.95. So this is the price before the IV spike on 16th of August. So the price is over here when the price is at the highest and the IV is actually relatively low. So let's take a look at today's price. Today's price based on what we have done over here, a research over here. Okay, 5,200 to 5,300. Alright, so if you look at the price, this is the first value, it is for September price, and the next value is for October price, and the first two is 5,200. So I'm going to try to key in this price first. So on high IV, which is last night, end of last night, closing price, 5,200 would be $23.30, right? And on October expiry date, the price is $37.70, right? And for 5,300, okay, let's take a look at the price at 5,300. Alright, so stick with me. I will show you why I actually chose two different strike prices, 5,000, 2,000 and 5,000, 3,000. Okay, and over here we will have the September will be at 30.60 cents. On October expiry will be at 47.75 cents. Okay, so for calendar spread, basic understanding is if you are to sell far away from at the money, you will be selling the one with the higher price and you're buying one at a lower price, so you get a credit for it. So I'm going to, so this is the first sell calendar. Okay, so this price is going to be negative the October strike price and plus the September price, and you have a net credit of $9.75. Now, the risk about calendar spread is when the IV spike, IV increases, your price will increase. As you can see, it increases 80 to 122. It's like almost 100% of price difference. So it is actually very dangerous if you do not manage your risk properly. So how do we look like when we actually sell a calendar, and let's say you enter just 2 days ago and today the price spike. So let's take a look at, so I'm going to just copy this formula and I'm going to put it over here. Alright, and what it's taking is selling the October price and then buying the September price, and what you get is negative 14.40 cents. You are selling at $9.75 yesterday, and today the price becomes a negative $14.40. So where's the profit? You'll be asking. Yes, this is the risk of calendar. If you sell at low IV and buy at and buy back high IV in case you want to close your position in order to prevent margin call. So this is actually very dangerous, right? Immediately you would have lost $14 minus $9, about $4. $4 per contract will be about $400 if you sell one calendar spread. Alright, so how do we actually sell a calendar spread when we are at low IV? Okay, very simple. Let's try another setup. So the trick over here is if you try to sell the option on the October period, alright, so it's equals to negative selling this price, and you will buy back at a nearer strike price to the market, okay, your net profit will be $6.40 per calendar. Now let's take a look at what happened to this trade when you hit a high IV, Command V. Alright, so from here you can see that from selling $9 to $14, what's the net change? So let's take a look at the percentage. Is equals to this price minus of this calendar, okay, and I'm going to divide it by this calendar price because it's the percentage of what we have lost from putting. So it's about 47, so I'm going to format this guy, format cell into a percentage price, hit OK. So it's about 47% increase in terms of loss because it's a negative, right? So let's take a look at this value if we were to set it to the other trade. So from this trade, tentatively, we'll be having a loss of negative 10% instead of negative almost 50%. So this is the one recommendation that you can play around with the price, that is, you sell a put on October, the further away strike price, and you buy back at the nearer strike, at the nearer expiry date, but nearer to the market price. At least like for Nasdaq, it's about 100 price difference. And although you profit lesser, but the risk you get is it's like 5 times lesser. Okay, so this is actually how you can actually control your risk. So you might be asking me, why is this so? Why is it that because of IV spike, and why did my price actually go up so much? And that is because IV itself, for out of the money, the IV spike actually increase and affect the price, the mark price of your option. Okay, if you don't believe me, let's do a quick mathematics. So for October, I'm going to use the same formula. It is equals to current price 37, okay, minus of $20.20, and this will give you the percent, the price increase. Am I right? So this will give you a price increase, and you divide it by this base price, which you have increased 86% increase in price. When market of Nasdaq drop, you lose by delta. Second, you lose by Vega, your IV spike. So 86%, and how accurate is this? You can see over here, the price over here. Net change yesterday from October is actually 86%. It's almost as accurate as what the data is given by TOS. So same thing, I'm going to use this copy and I'm going to paste it over here, and you can see the price is almost the same. So what actually happens on high IV is the one that is nearer to the expiry date will increase in the price much more than the one that is further away from the expiry date. So that is actually how you can actually tackle between a shorter expiry as a benefit to hedge on a downside or IV spike, and sell the October price, because it does not increase that much. So as time decay, you are still able to profit this $6.40 over the next 1.5 months. Right, so you'll be wondering, 10%. Okay, so let me just summarize. First point. Sell longer expiry, buy shorter expiry. So that's the first thing that you will do to create a calendar spread. So the second point to take note is sell away from market and buy nearer to market. And this will actually protect you to a certain extent that you do not lose so much in terms of when the market crash or when the IV actually spikes. Now I'm going to show you the third thing to walk away with when you're actually selling a calendar spread to protect you even further. So I'm going to show you in terms of ratio. What I'll do is I sell this guy, am I right? And I buy the nearer to the market and shorter expiry. Okay. Now, we can actually mitigate even further if you were to sell, say for example, 10 contract and you buy back, multiply by just one contract extra, 11. Okay, you sell 10 of them and then you buy back them with 11. Okay, now let's take a look at what happened when IV spikes. When IV spikes, your credit from negative 50 reduced to 40. So if I were to use the same formula, because this is a negative, I'm going to put a negative over here. Okay, and I'm going to put a negative over here so you can see that you actually have a negative value, which means you have a loss. So if this value, you were to paste it over here, you are actually profiting when IV spikes because you have one extra put. Just one extra put for every 10 calendar spread you have. And with this, when market goes down, you are being protected by the one put because it actually increased so much more and you can actually benefit from it. So what happens if you do not, if the market remains constant, if the market does not IV spike and it's going bullish all the way, your net is a negative 50. Okay, you have a credit of negative 50. So as time decay goes on, 1 month later or 1.5 months later, you will collect the premium and sell off when the nearer date expires. Okay, so the third thing that I'm going to share with you is sell 10 but buy 11, or in another words, buy one extra put to hedge IV spike. Okay, so this will actually gives you a very nice selling calendar spreads over 1 to 2 months time of your trade and giving you profit based on time decay, and you are being protected from IV spike. Okay, so how does this trade actually looks like for the profit and loss graph? Okay, so this is roughly how it looks like. If you have a trade like this, it will curl up from here onwards. Okay, so here is where you actually hedge. When IV spike, you actually hedge it up this way. So you'll probably have a lesser loss when a market crash or when market is market have an IV spike. Okay, so I hope you have benefit from this. Of course, there's a lot more things for you to understand from selling a calendar spread. And if you like this video, please like and subscribe to my channel. And at the same time, you should have a lot of questions to ask. Please comment below and ask me any questions that will be pertaining to your queries about selling a calendar spreads. Thank you very much for watching. I'm Nashlin from Safe Investment Options. Goodbye.